Okay, now I will introduce the step 3, journal entry. Record the transaction in a journal. This is also called journalization. Basically, following the transaction analysis, we use standardized journal entry to record this transaction in a journal. What is journal? Usually the journal should include the date, on what date, time, and who are involved, and what happened. Okay, so for accounting, the journal is same thing. It provides a chronological record of all economic events that affect a firm. Each entry is expressed in terms of equal debit and credit. There are special journals and general journals. Here, the example I focus on the general journal. Later, I will introduce what is special journal. Let's first just do a trial, how to make journal entries. $40,000 borrowed from banks by signing a notes payable. So we know the company received $40,000 cash increase. We're going to debit cash. Remember the T accounts, right? 40 grand. Another one is notes payable. Notes payable increase, that's an increase in the liability, $40,000. This represents a claim of the bank. Debit $4,000 cash, credit notes payable $40,000. And then we just reorganize it into this format. This is a journal entry. This is a simple version of journal entry. Okay, it includes the accounts. There must be at least 2 accounts. Column debit, column credit. We must debit one account and then credit the other one. For the accounts that are credit, we indent a little bit. The purpose is to separate the debit accounts from the credit accounts. It's easier to identify which account was debit or credit. We will show the amount in the debit column followed by amount in the credit column. Usually we should also have another column before the accounts, that's the dates. This example does not provide the information about the date. So for simplicity, we do not show the date information in the journal entry. Next, we will prepare a journal entry based on the following information for July 2024. This example is separate from prior example I used, so do not be confused. We are given all the transactions that occurred during this accounting period, from the first day of July to July 30th, which is not last day of July, but I think this is the last transaction occurred in this month. Based on the following descriptions of the transactions, we prepare the journal entries. On the first day of July, 2 individuals each invested $30,000 in the corporation. In exchange, each investor received 3,000 shares from their investments. And we know these are contributions by the investors, the owners. The corporation received $60,000 cash from the shareholders or the owners. The shareholders' claim increased by the same amount, $60,000. Based on the description, we know the 2 accounts that are affected, cash and common stock, because of the issuance of common stock. The amount contributed by each individual was $30,000, while the share is 3,000 shares for each. The stock price is $10 per share. So we are going to credit common stock, which is account of stockholders' equity. While cash increased $60,000, equity increased $60,000. Then we convert this information into a journal entry. Date, we debit cash, right, on the left, and credit common stock on the right. So this is the first journal entry. From the description of the transaction to journal entries, we do not lose any information. The journal entry keep all the important financial information and also in a standardized format. You will see later on all the journal entries are in the same format. Okay, second, on the same day, July 1st, the company borrowed $40,000 from a local bank, signed two different notes. One note is $10,000, interest 10%, the duration half year. So this is a short-term note payable. While the second one is $30,000 principal, interest 10%, and term was 2 years. This one should be classified as long-term note, okay, because the duration or the maturity is greater than 1 year. But I think in this book, the author simplified this example by combining these two notes in one. So it used 40,000 instead of two separate, 10,000 and 30,000. So we just follow this example. The company received $40,000 cash from the bank, right? So the cash accounts increase $40,000. So for cash account increase, we put on the left as debit. On the other side is note payable. I use NP to represent note payable. And this represents claim from the creditor, $40,000, a liability. Claim increase, so we put on the right of notes payable. This is a credit. And then we put the information together and make journal entries like this. On the same day, July 1st, we debit accounts, $40,000, and credit notes payable, $40,000. I personally prefer to do two different journal entries. One is debit cash and credit short term. ST represents short term. Okay, the first journal entry should be 10,000 and then credit 10,000. And you make another journal entry. Cash LT represents long term notes payable. So cash $30,000 debit and $30,000 credit for the long-term notes to differentiate these two different notes payable because they have different duration or maturity. They will be reported in different accounts in the balance sheet. And you may ask, we are also given the interest rate. Why we do not report interest rate in this journal entry? Because on the first day, there's no interest expense has been incurred. On this day, they just signed the notes, the company received the money, and then recognize the liability. But no interest has been incurred. So now we don't worry about the interest. All other information related to this transaction, which is not reported in the journal, will be in the notes. Next, on the same day, again on the first day of July, the company paid $24,000 in advance for 1 year rent on the store building. The paid $24,000 indicate it is a cash outflow, right? The cash will reduce. So for the cash accounts, we will put the amount on the right as credit. But what account will be debit? Because this is a rent for 1 year. But keep in mind, we are now just in July. So in this month, the company actually only incurred 1 month's rent. However, it prepaid for a whole year, 12 months rent. The $24,000 is not rent expense. Why? Because that's just the first day. The lease just starts and no expense incurred. How to deal with this $24,000? Actually, in accounting, we record it as an asset, prepaid rent. Because it is an asset, it increased from 0 to 24,000. Yeah, that's why you see the journal entry with on July 1st with debit, prepaid expense, and credit cash, $24,000. So here you may confuse between these two. One is prepaid rent, the other is rent expense. Their difference is this is an expense. This represents the consumption of the resources. Right now, on July 1st, on the first day of the lease, because rent is a function of time, there's no lease expenses incurred. We only recognize 1 month lease expense by the end of July. But now we are on the first day. Although it is a payment to the lessor, the landlord, but if we ignore the penalty or transaction fees, the company can get a refund completely. So these are still the assets of the company, is a lessee. So that's why we treat it as an asset instead of an expense. This is a little bit challenging if you are new to accounting. Yeah, prepaid rent is not an expense. It is an asset because it is prepayment. Okay, just like deposits, right? Deposits are totally refundable if you do not violate the agreement between you and the landlord. That's your money. Same thing for the prepaid rent. Next, purchase office equipment from Electronics for $12,000 cash. So this is a purchase, and assets is office equipment. The assets office equipment. I just use equipment. The company now has one more asset, equipment. The value is $12,000 because it is a purchase for cash. Cash will reduce $12,000. This transaction basically is the company use cash in exchange for another asset. So we debit office equipment because this number is on the left side of T account, and credit cash, which is on the right side of T account, credit. If we analyze the accounting equation, one asset increased $12,000. You know that's equipment, while the other assets decrease $12,000. The total assets doesn't change, just the type of assets changed. Another purchase on July 3rd, 2 days after, purchase $60,000 closing inventory on account. Closing inventory is an asset increased because of this purchase. So for inventory account, we put the increase on the left. So that's a debit, $60,000. And also this is purchased on account. There's no cash payment to this Birdwell Wholesale. We use accounts payable. And this is liability increased. Before this purchase, there's no such accounts payable. This liability results from this purchase on account. So we debit inventory and credit accounts payable. Again, let me use accounting equation to analyze the impact of this transaction on the firm's financial position. On the asset side, it has $60,000 increase in assets. Specifically, it is increase in inventory. On the other side of the accounting equation, this is $60,000 increase in the liabilities. You see the balance sheet expand, right? Because greater assets, greater liability. Yeah, the total amount for both sides increase because of this purchase. On July 6th, purchase $2,000 supply for cash. Again, one more purchase. The assets purchased were supply. Similarly, the supply as an asset accounts increase by $2,000 because it is purchase for cash, so cash decrease $2,000. We put the number on the right. Similarly, we know the journal entry, the date with debit supply, cash account indent, like 2 letters, then the amount, debit and credit, $2,000. The accounting equation, assets increase 2,000, assets decrease 2,000. Okay, from July 4th to 31st, sold merchandise costing $20,000 for $35,000 cash. This is a sale. When a sale happens, that also indicates this is a moment the company should recognize sales revenue because the company delivered the products to the customer. According to the revenue recognition, we should recognize sales revenue. The company received the cash payment from client, $35,000, while revenue or sales revenue increase $35,000. For the journal entry, we debit cash and credit sales revenue, $35,000. But that's not all. Remember, these goods or merchandise cost $20,000. There are another 2 accounts affected. One is inventory. Before the merchandise was sold, it is the inventory of the company. Because of this sale, the inventory reduced, so amount is $20,000 credit, while the company will recognize cost of sales or cost of goods sold. Expense, we debit $20,000. For journal entry, we debit cost of sales, expense, and credit inventory. This is a very typical accounting treatment for a sale. When the firm recognizes sales revenue, it should also recognize cost of sales or cost of goods sold. These two happens at the same time. Why? Because if there's no goods to be sold, there's no revenue. When you recognize revenue, that means you have one good. You have goods sold. I will talk about perpetual inventory approach or system later. July 9th, again, another sale. But this is a sale on account, not for cash. The amount of sale is $3,500. This is the sale, so we should do the similar journal entry. We will recognize revenue and the cost of goods sold. But the difference is, since this is sales on account, the company will not receive cash right now on July 9th. Instead, we recorded accounts receivable, which represents a future cash receipt. Right? See the difference between this example and the prior example. Here we debit cash, but here we debit another asset, accounts receivable, and we recognize sales revenue. Because of this sale, we know the cost of the sale, so we debit cost of goods sold $2,000 and credit inventory $2,000. The only difference is this accounts. Why? Because the difference in the description of the transaction. This is sales on account, while this is sales for cash. See, although these are 2 sales, but accounting treatment are different. 2 different stories. Here, the company recognized accounts receivable instead of cash. We know accounts receivable represents a future cash inflow or payments from the customer. So when on any day, based on agreement between this company and this school, on a certain day, I just use date, randomly day 1, the school pay the company. Then the school will receive. I also assume the payment is 100% full payment. So the company on day 1 will receive cash $3,500, while accounts receivable has been received, it should be removed. So this journal entry represents receipts of the cash flow from prior accounts receivable. This transaction now is complete. Okay, for this sales on account, only one party has fulfilled its responsibility. The company delivers goods to the school. The other party fulfilled its responsibility of payment later. Of this transaction, both parties fulfilled their responsibility at the same time. The transaction is done. The customer made the payment, the company provided goods and service. On July 16, subleased a portion of the building to a jewelry store. Received $1,000 in advance for the 2 months rent. Begin right on July 16th. So this $1,000, you may think that's a rent revenue, right? But just on July 16th, the firm should not recognize any rent expense because this is just the beginning, the first day of the lease. Instead, the company record a liability, deferred rent revenue. The rent revenue recognition is deferred. You will see the firm will recognize rent revenue later when time lapse because rent revenue is determined by the time or the usage of the property. You can think this way, just on this day, the very beginning of the lease, the jewelry store can totally get a refund, $1,000, if we do not consider any transaction fees. So at this moment, no rent revenue should be recognized. The rent revenue recognition is deferred. The company record a liability. Because the company received the payment from the jewelry store, there is a debit cash. So the two accounts affected is cash receipts, debit $1,000, deferred revenue $1,000, a liability. Then we prepare the journal entry. Debit cash $1,000, credit deferred rent revenue $1,000. We can also call deferred rent revenue as unearned rent revenue. The impact on the accounting equation. Assets increase while liability also increase. On July 20th, the company paid the supplier $25,000 on account. So this is a payment meant for the purchase on account on July 3. On July 3rd, the company debit inventory while credit on accounts payable $6,000. On July 20th, the company paid part of the balance to this supplier. So, because the liability is partially paid off, the amount is $25,000. We are going to debit liability because this liability decreased by $25,000. While this is cash outflow, the assets decrease. So we credit cash $25,000. The impact on the accounting equation, assets decrease $25,000, liability also decreased by $25,000 because of the payment. Pay salary to employees for the first half of the month. So the first half of the month, we can think it is it starts from July 1st to July 15 or 16. So this is the salary expense has been incurred because the employee has provided their labor. So we should recognize the salary expense. So we debit expense $5,000. This represents the expense incurred from July 1st to July 15. or 16. It doesn't matter. This represents the employee's first biweekly paycheck, $5,000. And because it is paid with credit cash, $5,000. The impact on the accounting equation, we will see an expense which will reduce stockholders' equity while assets reduce $5,000. The accounting equation is still balanced. Next, received $1,500 on account from a customer regarding a purchase earlier this month. This transaction is related to the transaction on July 9th. Remember, on July 9th, the company recognized revenue $3,500 and record an accounts receivable because this is sales on account. This is a pending payments expected from the customer. And on July 25, the customer partially made the payments. The company received the payments with debit cash and credit accounts receivable because we should write off accounts receivable by the amount received. Okay, so here the impact on the accounting equation, assets decrease 1,500. We know that's the write-off accounts receivable. Because of cash receipts, so the assets, cash, increased by 1,500. You will expect the rest of payments, $2,000 later. Assuming this customer will not default on this. On July 30th, I think this is the last transaction. The company paid its shareholders a dividend, cash dividend. So this is a payment, a cash outflow, $1,000. And when the company declared dividend and paid dividends, we will debit dividend. A debit dividend have impact on the stockholders' equity is decrease. Well, this is cash payments, so we credit cash. So the impact on the accounting equation is this. Assets decrease $1,000. This is a cash payments as dividend to the shareholders, while it reduces the stockholders' equity by $1,000. So when we debit dividend, it is equivalent to the debit the stockholders' equity. Okay, so far we have completed all the external transaction during this accounting period, July, for this corporation. We will move on to step 4 to post the information from the journal entry or the journal to the ledger.